Hello and welcome to the fourth video in the serial trading video series. I'm just going to look at some technical studies and basically just my take on them and how I utilize them. So I'll just go through this slide first. So most technical studies are derivatives of price movement and time using various formulas, and there's literally thousands of these, and a lot of them just show very similar things but in slightly different ways. I would recommend not getting too wrapped up in trying to find the perfect technical study. Instead, try to find some good ones that work and make sense to you and get more familiar with them and make them tools for yourself. Some are not. So even though most are derivatives of price movement and time, some are not, such as the advanced decline, volume, that sort of thing. But again, I don't usually get a whole lot of value out of volume or looking at the advanced decline line or any ratios of these things. Because often if you're looking for, say you have a price trend that's going up or a price trend that's going down, and normally during a trending period of time, the advanced decline line is trending up with the price trend or trending down, etc. Sometimes it diverges. But I find that often if you have a divergence in those things, usually there's a divergence in something like RSI that's more derived from the price and time movement anyways. So to me, I mean, maybe some people get value out of it, but I just don't get enough value out of it to look at it on a regular basis. But that's up to the individual, of course. Now, they should be viewed as a complement to price patterns, not the main focus. That's an important thing to look at. So when you're learning how to do analysis, the absolute most important thing is what you're actually trying to trade, and that is the price chart. So you ought to be analyzing the actual price chart most closely, and then everything else is just kind of viewed as something complementary, or confirming to what you're seeing in a price pattern. But it should never be the focus. You should never say, well, I have no idea what's going on with this price chart. I don't know what pattern we're in. I don't know if it's an uptrend or downtrend. But geez, the RSI level looks attractive. That's not enough on its own. Now, within the context of a mature-looking price pattern, and you have some sort of significant RSI reading that in the past has marked an important, high or low or close to it, maybe that's something to take more seriously. But not just that by itself. Okay, select a small number of them that you like and that work for you. Well, I'm just going to go through what that is for me. Now, let's take a look at what I like and or use. Okay, let's do that. All right, so just looking at ThinkorSwim here, I'll start with, we'll just start from the top. So this is my page that I usually look at, I don't know about first, but quite often. And this is just a candlestick price chart, although it doesn't have to be. But I'll explain why I have it as a candlestick chart in a bit here. And it just has some common moving averages. So the 200-day simple moving average is in the red. The 50-day simple moving average is in the blue. The 20-day simple moving average is in the gray. And then you have the 8-period exponential moving average, also known as the T line or trigger line. And then the 3-period exponential moving average. Okay, and then down here you have a stochastic with particular settings, which I will briefly just put up here so you can just pause if you want to copy those settings. I'll give you the opportunity to do that. Now, this technical page, if you will, this is derived from Stephen Bigelow and the Candlestick Forum. This is like their main way of looking at it. They look for candlestick signals in relation to all these moving averages and also the T line or trigger line. And I won't get too much farther into that. If you want to learn more about it, you can certainly go check out Stephen Bigelow and some of his work, but that's where this technical page came from. Okay, so the next thing I'm going to look at is something I've been using a little more recently. I don't think I've really shown it on any of my videos as of yet, but definitely something I'm seeing some value in. So in Spike Trade, and that's the group that I mentioned in the introductory video, one of the places where I've learned some of my game, spiketrade.com. They widely use what they call ATR channels or average true range channels. Now what they actually are is just a selection of specific, let me just get here, Keltner channels, okay? So the way to do it on ThinkorSwim was just add 3 Keltner channels, and then you change the settings. I believe this is the settings that were default, but if not, just take note. So the only real thing to worry about here, once you got all sorted out, is the factor. So 1 for that one, and then the next one 2, and then the next one 3, and that gives you your 3 Keltner channels that you're going to be working with. And the terminology would go is, since we're calling them average true range channels, so you have the +1 ATR, the +2 ATR, the +3 ATR, and then you have the -1 ATR, -2 ATR, -3 ATR. Now there's also a way to do this on TradingView, which has been recently highlighted to me. And on TradingView, instead of having to add 3 separate Keltner channels and adjust the settings, you can just go and add what's called the Keltner -1, -2, -3. Someone's already made this, and as far as I can tell, it's identical to the 3 separate Keltner channels with the specific settings, so it looks like it's just ready to go. And it accomplishes the same thing here on TradingView. Now anyway, back to ThinkorSwim. So the idea behind this, now I think they have a particular focus on the indices, the way they use them at Spike Trade, but I think it largely applies to any price chart you're going to be looking at. So typically, highly overbought would be like the +3 ATR, and you can see the S&P 500, for instance, it rarely gets at or above the +3 ATR, and certainly when it does, it typically at least yields a pullback, if not a larger reversal. And you can just go back and confirm that over and over. Same with the -3 ATR. That's typically quite an oversold level, and at the very least leads to a bounce, if not a reversal. But there's also something called ATR channel divergences, and that's where, okay, so here we got to the +3 ATR. We had a big pullback, which actually went down to the -2 ATR. Now we got back up, not quite to the +2 ATR, even though it was a higher high in price, it was a lower ATR channel. So that'd be what's called a bearish divergence with the ATR channels, and a potential selling or shorting opportunity, according to that method. And the same works in the opposite as well. Now again, I won't spend too much time on it, but if you want to learn more about them, I think they have specific courses actually about ATR channels and whole actual trading system around them. But for me, I like to look at it in complement with price patterns. So for instance, here you had a 3-wave move up to a new high on the S&P and a bearish ATR channel divergence. And obviously that led to quite a nice move down there, didn't it? As one example. And you can see on our recent sell-off there into the January low, we got below the -3 ATR channel, and we didn't really stay below there. I don't even think we stayed below there once on a closing daily basis. If I were to go to a close-only price chart, I think you would find you didn't even actually close below the -3 ATR channel. So that was a sign that at the very least some sort of relief rally was due, and we've so far had some sort of rally. It still remains to be seen whether it's going to be a new uptrend or just a relief rally and then something else coming to the downside yet. I think that's still kind of undetermined here, although I still currently have a little bit of a bullish bias. That's certainly getting tested as of today. Not broken, but tested. Okay, so that's the concept of the ATR channels. Now, as far as the colors, I mean, you can change the colors. You can change what kind of line. You can just have a dotted line. That's completely up to you. As long as you have the basic settings in order, that's the main point. And what else to really remark on here? Yeah, usually in a nice, relatively behaved uptrend here on the indices, typically a pullback to either the -1 or -2 ATR yields a pretty good entry point. And then when you get, very oversold, the -3 ATR. So that's just something to consider. It can also help you establish stop loss levels. Like if you're buying a pullback, say to the -2 ATR, you can put your stop below the -3 ATR once you got a little bit of a reversal starting off of there. Same with the -1 ATR. if you have a little bit of a reversal starting off the -1 ATR, you could enter and put your stop below the -2 ATR. But again, there's a whole system around that. You can dive into that if you want from spiketrade.com. Okay, so that's probably all I wanted to mention about the ATR channels. Now, what else? We could go to just a fairly typical chart here, and we just have a standard 14-period RSI. Let's go to the daily chart. Now, this stochastic setting, I don't really... I mean, I guess it's fine to leave it up there. But I typically just look at the RSI and the MACD with this. And what you'd be looking at for RSI, a couple ways I use RSI. So obviously overbought and oversold, and not just overbought and oversold, but overbought and oversold according to the price chart itself. So let's just say the S&P usually gets into the mid 70s or something. I'm not saying that's true, but let's just say we can look back and say that, okay, most peaks kind of topped off in the mid 70s on RSI and the S&P. Well, if I was getting to the mid 70s in RSI on the S&P, I certainly wouldn't be trying to initiate a long position. I might think about selling an existing position if it was doing well, or at least starting to take some, protective or hedging action, etc. But other than extreme overbought and oversold, which RSI certainly has its purpose for that, there's also something called range rules. So in a bullish uptrend, you typically see it pull back into the range between 40 and 50 on RSI. Usually holds that what's called bull market RSI support. And then if you're in a downtrend, you typically find resistance in the area between 50 and 60. That's called RSI bear market resistance. So those are some things to learn about. And then, of course, yeah, just standard overbought, oversold. Now, there's also divergences with RSI. And if we were to go to, maybe we'll go to an hourly chart or something like that. Okay, here's a good example. More recently. So here we got overbought on, this is the hourly chart. Overbought hourly RSI. Now, typically, you don't actually make a top or a bottom just on overbought or oversold condition. Typically, you get overbought or oversold, have a reaction from there sometimes, and then come back to that same area or beyond, but make a weaker reading, so a lower high in RSI despite basically a double top or sometimes a higher high in price. That can be called a RSI bearish divergence, or if you are doing it on the other side, RSI bullish divergence. Let's see if we can find potentially an example of that. Going back here. Okay. I don't know if I can find a real clear example of an RSI bullish divergence. Maybe on the 4-hour, we'll have a look. Here's a decent example of that. Okay, so back here in, it looks like, what was that, August maybe? Something like that, of 2020. So here we got oversold on 4-hour RSI. We had a reaction off of that to relieve that oversold condition. We came back down, made a lower low in price, but we made a higher low in the RSI here on the 4-hour. So that could be considered a bullish divergence. And then once we start getting some reversal to the upside, that was confirmation that, hey, maybe that was a tradable bottom, and then we had some movement upward. So that's just, not to dive too far into it, but that's the concept behind it, right? So you look for extreme overbought or oversold conditions. You look for bull or bear trend ranges to hold on pullbacks or on corrective rallies in a downtrend. And you look for bullish or bearish divergence near, trend changes. Obviously, you're in a downtrend. If you're starting to develop a bullish divergence in RSI, you might start to consider looking for the beginning of an uptrend and vice versa. Okay, so that's the RSI explanation as far as how I look at it and use it. Again, there's no magic here. RSI is just a derivative of basically price and time movement through a certain formula. So you're really just seeing a different way of looking at what you're already seeing on the price chart, but it can be helpful. It's more objective than just trying to eyeball things all the time. It gives you some context at least, right? As far as stochastic goes, well, that particular stochastic setting, I can just show that it's different than the first stochastic setting that Stephen Bigelow and the Candlestick Forum use. I'll just give you a little look at that. I don't think there's anything else remarkable. No, these are just like colors and the way I've, decided to display it. But the actual parameters, I think that's all you need there for that stochastic setting. Now, this stochastic setting, basically you're just looking for overbought or oversold readings. It doesn't tell you a whole lot more than the RSI does, although it's a little different. To me, it's a little bit redundant. I would even opt to just remove that study and just look at the RSI and MACD, but in case anyone wants to use that stochastic, there's nothing wrong with it if you want to make it your own. Then there's the moving average convergence divergence. Now, this is a very much a lagging indicator. So these are oscillators. The stochastic and RSI, they're quite responsive. They're price-based oscillators. So they'll react basically in real time to price. Whereas the MACD, that's the moving average convergence divergence. That's more of a trend following indicator. So it's a bit of a lag to it, which is fine. And the idea behind MACD is whatever time frame you're looking at. So this is the daily chart. So daily time frame. If you're above the zero line on MACD, the trend is technically up. And you're just looking for counter trend or continuation moves. So for instance, here we had this MACD cross downwards, and that's where the 12 period moving average crosses below the 26, but we're still above the zero line. That would be considered a pullback within a still larger uptrend. And you can see we held the zero line, and then we did go up here and make one more high. But then when we actually cross down here, not only do we have the 12.26 cross down, they actually got below the zero line, and we're still below the zero line. So technically, according to MACD, at least for now, the daily trend on the S&P 500 is still technically down according to that indicator. But if we go to the weekly, now again, this is all a function of the time frame. If we go to the weekly, the trend according to MACD is still up, although we're in a some sort of corrective period, which I'd say that makes quite a bit of sense with what we're actually seeing in price. To me, it looks like we are still in an overall uptrend on the larger time frame, but we're in a corrective period, possibly working on getting out of that corrective period. So again, no magic here. The focus should be price, but it's still good to have these objective technical studies to complement your price analysis. Okay, anything else I want to look at here? Just one more thing about the MACD. So there's also that's called this MACD histogram, and you can look for MACD histogram divergences. Like we'll say we're in an uptrend. I guess here's an example. So we're in an uptrend here still, but you can see the MACD histogram diverged compared to where the MACD histogram was here before. So that's like a MACD histogram bearish divergence. But again, it gets a little redundant because you could have just been looking at RSI to have a bearish divergence as well. So again, you're looking at largely the same information in some cases here with technical studies, just displayed in a little bit of different format or different visualization of it. So not to focus too much on this. Now, the real purpose of these technical studies is just to be a complement to price and the patterns in price. And really, the true focus is finding actual price pattern-based trade setups with defined parameters, and also consistent readings on some of these technical studies to complement those price patterns to add confidence. And that's really what later on we'll actually be getting into specific definable trade setups using all those things together. So I think I'll probably just wrap this video there. I think I've presented the technical studies that I personally use and some information about them. There's certainly more about them to learn. Again, I would recommend, if you like the Stephen Bigelow technical study page there and the Candlestick Forum, you can go check them out, learn more about it. And that also combines candlestick reversal and continuation signals along with those things as part of their system. I may look at some candlestick stuff in some later videos as well. And then there's the ATR channels and the whole system around those. You can certainly learn more about that through spiketrade.com. And then there's just what I discussed here with the RSI and MACD, and there's certainly more to learn about those, but I think I gave a decent rundown on it. So any questions or comments, feel free to sound off there after the video. But if not, we'll see you in the next video. All right, thanks.